talking about preparing for a potential weak U.S. dollar, higher inflation, and in the light of the international perspectives, how do you see the international side of your portfolio?
Most of our bias is in China. So getting back to that point, we've added a lot in recent years. I think we might add a little bit more, but we've got probably 10% of the whole portfolio is exposed to China. So it's a pretty big bet.
How does that break down?
It's a combination of long only. It's all active management. So it's a combination of long only, mainly A shares, active manager of the A shares. And then we've got a couple of hedge funds that are based in China and focused on the China market. And then we've got some exposure in the private portfolio, primarily venture capital. So, and I agree with, a lot of the comments that were made. I think it might've been Todd who was doing the top 7. I think we're the same way. We think technology and innovation is really important. We've been doing a lot of work over the last few years. I mean, we have a lot across our public and our hedge fund portfolios. And, we're doing a lot of work in venture as well. So, I mean, that's an area that we just think is important regardless. And, but, like I said, I think what we'll look at is just tweaking a little bit around the margins and I'm in the middle of this work, so I haven't really landed on kind of what my recommendation is going to be to the committee. But I'm thinking more like just a basket of small bets in a number of things that together, maybe it's $10, $20 million out of our portfolio. That's about $950. That's just adding a little bit of exposure. Maybe it's a little bit of Bitcoin, maybe it's a little bit of gold, but gold through a manager that's doing other things, right? So that they're going to be a little more active about when to put it on and take it off with other things. And then, maybe increasing our emerging markets exposure, which is primarily China. Maybe doing a currency hedge, which we haven't done in the past. So it's like I'm sort of leaning towards a basket of things in a modest amount of money. Because like I said, we have a core portfolio that we really like. And from a long-term perspective, we think sort of this tech bias that we have, the growth bias that we have is the right place to be over the long term. And I think it was Eric who said earlier, for the most part, we can take some shorter term volatility. So we're not going to drastically change our overall strategy.
And how about your sisters and brothers and your role in university? Don't they have to keep?
Right, there's a lawnmower outside my door and it broke a window a few minutes ago. So not in my office, but around the corner. I can't hear you. What was that?
I was saying other endowment CIOs like you, but in larger universities that may not be able to contain COVID impact, are they having to keep their powder dry to be liquid to get through this period, or what are you hearing from them?
It's so case specific in terms of the size of the university, the size of their endowment, what their allocation is. We have a pretty low fixed income allocation. Some folks have a higher fixed income allocation. Do you have a line of credit? Denison does. A lot of institutions have them. If you didn't and you had to go get a line right now, it's very expensive for the folks that went out and tried to get a line of credit in this environment. They might have gotten it, but they paid a lot for it. But I do think overall, there's in higher ed, there's just a level of uncertainty. I mean, we're happy right now. Could we have an outbreak tomorrow and have to send kids home? Yeah, that could happen. We don't think it will, but it could. Could something worse happen in Ohio and the governor changes the rules and we have to comply with that? I mean, those are the kinds of things people don't know. And I think, like I said, winter is a big issue for a lot of schools. The more the students are in their rooms hanging out, the greater the potential is for a problem. And I think a lot of schools are, they've been dealing with, like, we've been in crisis and we've been very worried about like getting the fall set up so that we can invite students back. But the traditional recruiting that happens and students being able to come to campuses and visit, like the the seniors in high school, juniors and seniors who will come to campuses and visit, they're not doing that right now. For the most part, they're really not doing that. And many students haven't taken the SAT or the ACT exams. And those are like early indicators to universities of who's interested in their schools so that they can do more targeted outreach. None of that's happening. And so I think, people will get through this year, but then next year is kind of a big question in higher ed. Will you have the same kind of enrollment? Will you have the same kind of applications? Are people going to get through this period and say it's not worth the money? The rise of all of this online educational opportunities, will there be a subset of students who just say, I'm not going to do 4-year, or families who say, we're not going to pay for that, you're going to do something online instead? So I think there's just a lot of uncertainty. People are going to make their way through this year. I think next year is a big question mark for many, many places. So.
Interesting. Kathleen, you brought up liquidity management at some level there, and it sounds like you've got a couple of options there. Obviously, access to credit to help you with that. I'm curious, maybe for other folks. I mean, typically, and I've worked with the foundation over the years, and we kind of knew our liquidity needs going into the year, and typically we'd park in a basket of bonds, earn some level of return on it, knowing and keeping the vol low, and funding that liquidity through that. That option's kind of gone away now, unless you just don't want to earn a level of return. I'm curious as to how people are looking at liquidity in the portfolio and how they're tackling it in this environment.
Yeah, I mean, I haven't talked to a lot of different universities about what they're doing with fixed income. I think people generally have some allocation. It may be small, but they've got some allocation to cash and fixed income, or at least an operating level of cash. And so if they've got privates, this environment has just raised, it's sort of the scenario testing that you do regularly. So what do we do if we're not getting the kind of cash distributions that we would normally get out of our private portfolio? And that becomes a bigger demand on our liquidity, right? I mean, that's where having lines of credit can be helpful, or you have to be much more active in rebalancing across your marketable assets. So, we've got a pretty low fixed income and cash allocation. And, in the thick of things in March, early April, we talked to our committee about it. And, we just said, we really want to preserve that allocation because we don't know what the fall will look like. We don't know whether we'll have a higher demand for liquidity. So to the extent we have to pay for capital calls or we've got the spending requirement, we're going to make sure we're redeeming things in advance. But at the same time, we delayed paying our quarterly spend for 2 months because we thought, what, we're not going to redeem things out in the midst of March, right? That didn't make sense. But we didn't really have capital to be over allocating to equities in March. We could really just rebalance. So I think you just have to be very, very active and very on top of your cash flow. So we talk about it every week. We're managing out. Okay, we're going to take 1 million from here, 2 million from here. December we got an $8 million payment out. Where's it going to come from? So we've always been very good about that, but we've just taken it to the next level because we want to be really thoughtful about where every dollar comes from.
Can I ask a different? Go ahead, Jim.
You just talked a little bit about cash management, which is obviously important in any situation, but the more I learn and listen, the more I hear that universities as a whole are under a lot of stress, a lot of increasing financial stress, and as an asset manager with with that level of uncertainty, And there's a lot of, I think, stress in the financial system today as a result of the last 6 months of uncertainty and cash consumption. How do you think, I'm just curious how you think about the risk to the financial system today from an investing perspective and asset management perspective, because I happen to believe that the banks have to be under tremendous stress and have really burned through a tremendous amount of their reserves that built up over the last 10 years. And so I'm wondering if that's a shoe that's going to drop, and how you as an asset manager think about what that stress in the financial system looks like today.
You're asking me this question?
Yeah,
Okay.
as an asset manager,
I think there's the potential that, I think the banks have gotten a lot of protection too through Fed programs and stuff, but I think there's the potential that if we have a crisis today in terms of the economy is not doing well, does that become a financial crisis? Does that become a liquidity crisis? I do think there's the potential for that. We're not, other than sort of managing our own capital, we're not drastically changing the way that we're investing though. Okay. I think, so yeah, I mean, we got through 2000, the big financial crisis fine. And I think the big question there was liquidity over a few years. And so that's why we've done a lot of stress testing. We really manage our private allocation. I mean, I'm all for actually increasing the private allocation, but I think then you just have to manage what liquidity, how you can access your liquidity elsewhere in your portfolio. Because, I think Denison will be a winner coming out of this. I don't think all schools will be. I mean, I think this crisis is going to accelerate what would have happened over the next 10, 15 years in terms of a lot of schools probably would have shut down. That's probably going to get accelerated by this. And I think, a shift to online education, there probably would have been a much bigger shift to that over the next 10, 15 years. And that's probably getting accelerated as well. So I think a lot of universities are also then accelerating their evolution to figuring out, hey, how do we stay relevant and how do we shift our offerings and further define who's our target consumer, who are we attractive to? So I think that's all going to happen. But at the end of the day, our endowment's going to be supporting the college for, decades in the future. And so that's, we have to keep our eyes on that. I mean, I don't know if that helps, but.
Let me shift.
What is your strategy in terms of private equity? Because this is what we focus on, and what we've been doing in the last years is more focusing on secondary and direct opportunities, which have a shorter duration and end up also having higher returns. I mean, how do you view that space?
Yeah, I mean, I think a secondary, we don't do direct secondaries. We don't really have the team to be evaluating those. I mean, we would look at a secondary fund as an investment. We might sell into the secondary market. We don't control our duration through our private portfolio. So I think I think secondary funds are attractive in the sense, to your point, where you may get better cash flow characteristics in those investments. But we are comfortable with the illiquidity that we have in our private portfolios. And we do feel like that's an area where we should get excess returns. And if we can't, then we shouldn't be doing it. So, where we've been sellers in the market, we've been selling things that we don't think warrant locking up our capital. And so, that's what I'm saying. I think it's an area that could grow as we work to access, other managers that we think could be really additive. But when we do that, like today, we're about 32% in privates. If we were to go higher, then I've got to make sure that the liquidity in my hedge fund portfolio is that I've got enough quarterly liquidity in that portfolio to, offset the more long-term lockups that we have in the private side.
So let me ask on that point.